Hi, it's Tim Quast, founder of Market Structure Edge, and thank you for using Edge. I'm going to take you through the 5 easy steps for using the platform. It's not complicated. I'm sure it takes some time to learn. When I first started using Edge, even though I knew market structure, I've been doing this market structure thing for close to 20 years. And even so, when I then applied that math to making decisions about what I would buy and sell, it took me a little time to learn. And so I use it too. This is the only tool I use for trading purposes, and there are 5 easy steps. So number 1, you want to understand the dashboard. 2, create portfolios. You'll see on my screen I've got a bunch of them. 3, learn entries and exits. 4, backtest your data. And 5, manage overall risk. So we're going to begin with understanding the dashboard. That's where you arrive when you log in. We create 12 portfolios for you, 11 sector portfolios that are dynamic. So if there are changes to those sectors, the data will adjust. We use data that keeps those things current. And then we add the FANGs, because while that's going to be overlap, those 11 sectors include the entire market. The national market system in the U.S. stock market, that does not include NYSE American stocks. That's it's 10 basis points of market cap. The largest 3,000 stocks in the market are about 99.9% of all market cap, $50 trillion, and that will be clustered into these 11 sectors. And then the FANGs, of course, are primarily tech, information technology, but they're in consumer discretionary and communication services as well. So it gives us a full view of what all the money's doing. If you look at those 12 portfolios, you'll not only know what the FANGs are doing, but what the whole market is doing. And we want to use that data to understand how supply and demand are changing. This is not charting. It's not, technical analysis. The problem with technical analysis is it assumes all prices are equal, and they're not. If prices are being set by high-speed traders who don't want to own anything at the end of the day, that is different. It has a different effect than if it's, say, passive money reweighting into consumer discretionary or consumer staples or something like that. And so demand is an algorithm that takes into account those different purposes and their effect on price. And so then we have a read on what demand in the market is, and then below that, short volume is supply. And that's what you see in these portfolios. If I look at communication services here, the top bar is demand, and the bottom graph, not bar graph, is supply. And so we want to buy rising demand and stable or falling supply. And we had that in latter September in communication services. The demand trend was rising and the supply side was falling. Well, that tends to produce rising prices, just like it does in an economy, right? If there are supply chain issues and strong demand, prices go up. And so same thing happens in the stock market. And it's an easy concept. You don't have to look at charts or fundamentals or read news. Those things are important. We talk all the time about options expirations and month ends in the market desk notes so that you understand the significance of those things. But here we want to begin by understanding what the money's doing. And that's what we're doing. We look across, this is what I do in the morning. Look across the dashboard and say, what are the demand chart graphs rising and the supply graphs stable or falling, or is it the reverse of that? And we can look across here. This is in early October, and a lot of the market shows topping demand graphs and supply graphs that don't necessarily look great. So energy's been a terrific place to be. And you can see why. Look at that demand graph. It's a 10-point graph that tells us things are above 5, demand exceeds supply. And then down here, the supply side, that's just short volumes of supply chain. Let me explain that just very quickly. Short volume is not short interest. Short interest that people talk about is a 1974 measure. There were no electronic markets. There wasn't even an index fund until December of 1975. And short volume is a 2009 measure regulated by FINRA, which oversees the brokers. And that's a very contemporary measure, and it's the supply chain of the market. So by looking at that very quickly across our dashboard, we're gonna know what's happening. If we look at the FANGs, and the FANGs haven't even made it back to 5, and now sentiment's falling, and short volume, while it declined here just the last day or so, is above trend. Those are not great conditions. We want the opposite of that. We want rising demand and falling supply. So a week ago, good time to buy some of those. Now it's not, and we have to wait for those conditions to return. We want to take gains, not chances. And by understanding what all of the money is doing, that's our starting point. So that's the dashboard. First thing, look at what all the money is doing, and then we'll figure out where to focus our attention. And that's the next thing.